Very good morning. So what's the yesterday's discussion, Nana? Cost of capital, na? So first thing, students are expecting in detail discussion on each and every point, sir. Here, cost of capital is just a basic version to calculate problems. If I wanna explain cost of capital, it will take 10 hours only for cost of capital. Try to understand when it comes to the intermediate topics, I can't give 100% crystal clear explanation. Hope you guys understand. Why? Because it's a basic version. By using this, we need to figure out future problems. So if you discuss only inter topics, it will not complete syllabus within time, sir. It's not possible. Okay. So minimum 100 hours it will take to finish this Spm&Bv. So if you use notes of handwritten notes, we can save 20 hours. That's it. Within 80 hours, we can conclude this entire Spm&Bv. Okay. So my point, student will expect basic logic also in classroom itself. When it comes to the before exam, student will not asking about the logics. They need marks. Yes or no, no? So if you apply same logics in exam, you can't answer each and every question within 3 hours. Clear, sir? Okay, then fine. I think yesterday we have completed the concept of KD calculation, KP calculation, right? And as well KE we started, earning approach is completed, dividend approach is completed. The next model, Nana, CAPM. I hope everyone knows the full form of CAPM, capital asset pricing model. Here we are calculating KE with a basic formula called RF plus beta into RM minus RF. Okay. For this explanation, in detail explanation how that formula came, you will get clarity in portfolio management of SFM. Sir, clear, sir? Here beta calculation point of view, we have a multiple formulas. That entire formulas you are using in portfolio management. Coefficient, correlation, covariance. These are the topics in detail you will get a clarity in SFM. When it comes to the Spm&Bv, just I will tell how to calculate. Sir, clear, sir? Okay, then fine. When it comes to CAPM, everyone knows only RF plus beta into RM minus RF. The new two topics added in our book, build up CAPM approach, CAPM model and expanded CAPM model. Okay. Before learning that calculation part, tell me, there is a MRF company share, MRF company and Flashman company. Which company you will choose to invest? Flashman. Then ultimately you are also Flash. Your investment also Flash only, na? Yes, and apart from the joke, which company you will choose, Nana? Why? Why? You have multiple calculation. So it's a long run based company. The share price is very high. Their company earns more compared to Flashman company. Yes or no, no? Okay, then fine. As you said, you will choose a Flashman, na? Okay. If you want to choose a Flashman company, what your expectation? Are you expecting more KE than MRF or less KE than MRF? Why more KE than MRF, ma? More or less, ma? More. Why more? Risk. Why, ma? Risk. When it comes to in MRF company, there is a no risk. In MRF company, there is a no risk. Yes, in MRF company also risk, but compared to Flashman company, MRF company risk is less. That is the purpose only we are using a risk premium, RM minus RF. In public companies, MRF company or what are the company traded in the share market, public companies. So we are using a concept name called basic CAPM. And that basic CAPM, we are considering only one risk. That risk name is called risk premium, is also be known as equity risk premium. Nana, clear, Nana? But when it comes to the Flashman company, we have a multiple risk, Nana. Can anyone tell me the multiple risk involved in here? Here also there is a equity risk. Next. 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 What are the risk you are facing, Nana? Political risk. Yeah, no long run. No long run. Are you agree? Size risk is there. Size risk. What's the mean for size risk, Nana? They are not fully diversified. Public companies are fully diversified. Clear. That risk also you are considering. Because of that risk, are you expecting more or are you expecting less, Nana? Are you expecting more? Are you clear? Country risk. What does it mean for country risk? One point we discussed yesterday, economic stability, recession, expansion. If country economy fluctuated, that impacts your companies also, na? Yes or no, sir? That risk also more in where? Public companies or private companies? Private company. That's why you're expecting more. Sir, clear, sir? Specific risk is there, huh? Specific. What is a specific? Anyone? Specific. For particular company have some issues. Sir, clear, sir? That if you choose that Flashman company, you have to bear. Are you ready to bear without free of cost? No, no. Are you expecting more? Yes or no? Okay, then fine. Another risk name called liquidity risk. Another risk name called liquidity risk. Can anyone tell me the liquidity risk? Liquidity means converting easily to cash. Yes or no? No. Now tell me, are you ready to sell? First thing, you already have a shares, na? MRF company shares is there, Flashman shares is there. You ready to sell? Which company shares will buy by other party immediately? MRF company shares or Flashman? That's why in a Flashman company having another risk name called liquidity risk. Sir, clear, sir? Because of that liquidity risk also, you are expecting what, Nana? More. Are you okay? Now, when it comes to the CAPM, public companies, private companies, small size companies, startups. Out of these two classification, where you facing a more risk as an investor? Private company, small size company, startups. When it comes to the public company, basic CAPM is sufficient. What is the basic CAPM? What you already know about the CAPM? RF plus beta into RM minus RF. Now interlevel we learned sometime instead of RM minus RF they will give directly risk premium value. Yes or no? No? Now this risk premium is also be known as equity risk. Equity risk premium. Okay. Now when it come to, I hope you already know about the beta. What is the beta, Nana? Risk factor. Which risk factor, Nana? Two types of risks they will explain. Systematic, unsystematic. Which risk it is? Systematic risk. Sir, clear, sir? Now, if beta is increasing, your premium also what happen, Nana? Increases. If beta is decreases, your premium what happen, Nana? Decreases. Sir, clear, sir? Okay, then fine. This is the things we learned. RF means you already know. What about the RF, Nana? Risk-free rate of return. RM represent, Nana? Market risk. Okay. Now when it comes to the private companies and the small size companies and the startups, we are not using a concept of basic CAPM. We are using a concept of expanded CAPM or build up CAPM. Expanded CAPM, build up CAPM. Sir, when I am using expanded CAPM means if there is a beta. if there is a beta. When I am using this build up CAPM means if there is a no beta. Okay, then fine. How to calculate this expanded CAPM KE? KE equals to RF plus beta into RM minus RF plus, what are the risk you are facing, Nana? What are the risk you are facing in private companies? Company specific risk. For that company specific, they will give premium 2% or 3% or 5%. Company specific premium. Next, Nana, country risk premium. Next, size risk premium. Next, liquidity risk premium. By sum of all this is known as expanded CAPM, Nana. If we consider this all premiums, it is called realistic KE calculation. Realistic KE calculation. Guys, clear? For example, here the answer is 10%. Now when it comes to this calculation, 10% only, no? 1%, 2%, 0.5%, 3%. Now total KE is what, Nana? 10 plus 1 plus 2, 0.5 plus 3. What, Nana? What you said, Nana? Are you expecting more written in startup companies or less written, Nana? More written only, no? 16.5%. Comparing to what companies? Public companies. Clear, sir? So this is called realistic KE calculation for private companies, startups and small size companies. Sir, clear? Now when it comes to this build up CAPM is there, na? What is the clue we have when we are using build up CAPM? If there is a beta, there is a no beta. If there is a no beta, sum all risk premiums. Sum all risk premiums other than beta. Nana, clear, Nana? Now, how many premiums we have, Nana? RF is there, plus RM minus RF is there. What is that premium name? Equity risk premium or risk premium just, plus company specific premium, plus size premium, plus country, I said country risk premium. Next, liquidity risk premium, plus sometimes they will give industry risk premium also. Nana, clear, Nana? But we are not considering this industry risk premium in this realistic calculation. In realistic calculation, we are using only this. In expanded CAPM, we are using only these 4 elements. But when come to this build up CAPM, we are using all premiums. Nana, clear, Nana? That is a new concept provided in our Spm&Bv material. So based on that, one problem also they created. Are you okay? Then fine. Next, a few things you need to learn about the beta. Beta calculation. Anyone? Beta. Beta can be calculated in 3 ways, Nana. But here we are using just basic version. Covariance of market and security divided by variance of market, Nana. Covariance of market and security divided with variance. So I hope you know the standard deviation. How to calculate standard deviation? Stat. These are the important things in SFMR. Portfolio entire things are evaluating in this standard deviation, covariance, coefficient, correlation coefficient, etc., etc. Now the standard deviation equal to square root of variance, Nana. What you want for the denominator? Variance, na? You need to send that square root into this side. What happened? Standard deviation square equals to Sir, clear? Okay, then fine. And in one problem is there in cell practice, they are provided correlation coefficient formula also. The correlation coefficient formula, covariance of market and security divided by standard deviation of market, standard deviation of security. With help of this formula, we are find outing covariance. With help of this covariance, we are find outing beta. With help of beta, we are calculating Ke. Based on that, MCQ related problems are 2 added. That's it. Nana clear? Okay, then fine. The ultimate discussion is you need to learn about basic CAPM, expanded CAPM, build up CAPM. When we are using build up CAPM, there is a no beta. Market sensitivity we can't find out. Yes or no? No? That also be known as market sensitivity. Nana. Next, when we are using expanded CAPM, for private companies, if there is a beta, it is not for public companies, it is for private companies. When we are using basic CAPM, public companies, in entire all problems we are using basic CAPM only. But one problem they created, they especially asked, calculate CAP, basic CAPM, expanded CAPM and build up CAPM. For that problem purpose only we learned all those things. Are you okay? Okay, then fine. I think realized yield is there, na? KE calculation, realized yield model, fourth one. Dividend model is completed, earning model is completed, CAPM completed. The next concept, realized yield. This is not important for us. Sir, if I invest 10 rupees in one security, what is my expectation, sir? What are the things I am expecting? 2 things I am expecting. I will expecting every year dividend, I will expecting capital appreciation. By considering the 2 points, if you calculate KE, that is called realized yield approach. Now if I invest 10 rupees, I will expect what, Nana? Dividend, and I will expect appreciation. How you calculate appreciation? P1 minus P0. What does the mean for P1? Future market price. P0 represent invested value. How much you invested? 10 rupees, na? Now the share price is future 12 rupees. Now how much appreciation you got, Nana? 2 rupees. How that 2 rupees came is 12 minus 10. That is a P1 minus P0. Divided with how much you invested. So this is a way also we can calculate KE. These are the 4 models we have to figure out KE, Nana. Realized yield approach, earning approach, dividend approach, CAPM. Any doubt on this? Up to now? Clear? I think KD completed, KP completed, KE also completed. Sir, just for understanding purpose only I explained all those things, sir. But when come to the every problem, they will touch only dividend with growth model point. D1 divided by P0 plus growth. In some other cases, they are asking just directly CAPM, basic CAPM. That's it. Okay, then fine. Next, cost of retained earnings. It is denoted with what, Nana? KR. In our example, I told that retained earnings capital we taken from the company. Whom fund it is? Warner's fund. Yes or no, ma? Reserves and surplus is whom fund, ma? Shareholders fund only, na? Now they are also expecting extra money for that fund utilization. What they are expecting? Equity dividend. That point also I said. That's why KE equals to KR. KE equals to KR. Okay. But there is some note point is there. If there is flotation cost, if there is a flotation cost, KE not equals to KR. At that time you have to calculate separately. Nana, clear, Nana? Okay, for example, dividend with growth model, Nana. How you calculate KE? D1 divided by P naught plus growth. What point I said, if there is a flotation cost now, minus flotation cost. Okay. When it come to KR is nothing but KE calculation like that only now. But when it come to here, how I calculate this KR means T1 divided by P naught plus growth. Are you understand the differences? Why? In equity share capital point of view, we need to deduct flotation cost. When it comes to the retained earnings point of view, we need not to deduct flotation cost. Why? Because we are not selling anything. When we are paying flotation cost, if you sell security, public is not interested to purchase, at that time we will appoint underwriter, we will pay commission. But when come to the retained earnings point of view, I am not selling anything, just I am utilizing company funds. For that utilizing company funds, I need not to pay any commission to anyone. Nana, clear, Nana? Next, some more point also is there, Nana. Personal tax. Personal tax. If there is a personal tax, at that time also K is not equal to KR. That detailed discussion is not required. Just understand this, that is sufficient. Generally, K is nothing but KR. If there is a flotation cost, K is not equals to KR. And how to calculate means, this is a way to calculate. Are you okay? Okay, then fine. Next, cost of term loan. It is denoted with KT. Now cost of term loan, KT equals to just interest 1 minus tax. You need not to divide it anything. Why? You are not selling anything. You are just mortgaging your company documents. If you are selling some any security, at that time you have a net proceeds or sale proceeds. But when come to this security, there is a no net proceeds. No? Go and check an example point also. I used a name called mortgage, not selling. Nana, clear up? Okay. That's about a specific cost of capital calculation. Up to now, any doubts, Nana? Clear, na? Okay, then fine. So when it comes to the next important point, cost of capital is also be known as weighted average cost of capital. In Inter, you learned with help of tabular format. The tabular format is not for final level. Here we are using direct shortcut. KO equals to cost of equity into weight of equity plus cost of retained earnings into weight of retained earnings plus cost of preference into weight of preference plus cost of debentures into weight of debenture plus cost of term loan into weight of term loan. That is nothing but last column of the table. Product. Nana, clear, Nana? Sum of all product is known as what, Nana? KO. Or sum of all weighted product is known as KO. But when it come to, in our final discussion, this much of mess is not there, Nana. Just KD, KE, that's it. Just KE, KD. That means sum of these two is nothing but KO in many of the problems. You need not to calculate all. They will not give first thing. They will just say about the debt proportion, equity proportion. That is our learning point we learned in CFM, debt equity ratio. Nana, clear, Nana? Debt equity ratio. Clear? This is about KO. If you want, I will explain in tabular format also. For KO. Anyone? Is okay? Okay then. Okay, wait. When it comes to the KO, we can calculate in three ways. With the help of book value, with help of market value, with help of specific value or target value, something what they will give. If they give a guidelines, how do you calculate? That is called specific value or target values. Nana, clear? So, generally, these two we already know. Book value means what are the values they given in the question paper, that are the existing capital structure. If you dump that, if you calculate KO, that is called book value. There is no issue with the book value, but there is an issue with the market value. Anyone? There is a one small issue in the market value. No. When it comes to the market value point of view, we are not show retained earnings separately. we are clubbed into one concept name called market value of equity. Why? Because how to calculate market value of equity share capital? Generally, people says that number of equity shares into MPS. Now in this MPS, equity share price will be there plus profits also there. That's why if you multiply with the number of shares and MPS, the answer name is called market value of equity, not market value of equity share capital. Nana clear? That point you need to learn. Okay. Sometime we are show separately. Market value of equity share capital separately, market value of retained earnings separately. When we need to show separately means if this point is exist. If there is a flotation cost, KE answer is different, KR answer is different. Na? At that time, you need to split that market value of equity into what? Na? Market value of equity share capital portion, market value of retained earning portion. Can anyone tell me how to split this? How to split this? With the help of book value proportion. With the help of what? Na? Book value proportion. Now, if you want market value of equity share capital, you already calculated what? Na? Market value of equity. Na? How you calculate this market value of equity? Number of shares into MPS. But I don't want market value of equity, I want split. For the purpose, what you required? Equity share capital. Na? Book value of equity share capital divided by book value of equity. Now what does it mean for book value of equity? Book value of equity share capital plus book value of retained earnings. Are you okay? Now here you can also use a common sense. Out of total value, if you remove market value of equity share capital, you will get what? Na? Market value of retained earnings. Or if you want, market value of retained earnings equals to market value of equity into book value of retained earnings divided by book value of equity. This also be possible. Clear, sir? This is the only point you need to learn in market value calculation point of view. If there is a no retained earnings, there is a no problem. Nana clear, Nana? If there is a retained earnings, you have to check clearly KE, KR same or not. If KE is same, not a problem. If KE is not same as KR, so KR is not same as KE, at that time you have to do split. Are you okay? Next one. That's about the cost of capital, Nana. Come to this. See the illustration number 1. All are bacha things for you. If the rate at which the company can borrow funds from the financial institution is 11% and the tax rate applicable to the company is 30%, post-tax cost of debt would be debenture or term loan? Term loan, financial institution, yaar. Nana, clear, Nana? So 11% into 1 minus 0.3. Answer? 7.7%. This kind of MCQs they will ask in exam or a final exam. Seriously. I think everyone will answer one question, repeatedly they are asked in 2 times. If company raises capital fully equity, company raises capital fully equity, then company KO is nothing but 2 marks. You need not to give any explanation also. That MCQ is there in FM also. Exam 2 times they are asked. Clear now? That's why I strongly said in the intro class, you can easily get more than 60s. You can reach up to 80, trust me. Okay? Okay, then fine. Illustration number 2. If the 10-year government bond yields, can anybody say RF? RM or RF? Why? Comparing to private companies or public companies, government companies has a risk free. For all companies there is a risk, but when come to the public company, government company, less risk. Tell me, I have 2 options. 1 lakh rupees is there, share market, real estate. Which is the best option? Share market or real estate, which is the best option? What, sir? Different answers are coming. My real estate is the best option. Why? Because if you get, it will be triple into 4 or into 5. But risk also same. More risk, more return. But when it comes to the share market, comparing to the real estate, less risk only, no? Same thing. Now real estate SBI. Real estate is, share market is option 1. Or same SBI bank is there for a deposit. Which is the best option? If you are a risk taker, share market is the best option. If you are not a risk taker, less risk. The same thing RF is always talks about government securities, treasury bills, treasury bonds. Are you okay? Then fine. BSE Sensex return over the last 1 year, 15%. What about this, ma? The BSE or NSE is known as market, ma. RM. Assume the company beta is 1.2, risk sensitivity. The required return on equity, KE only, no? RF plus beta into RM minus RF. Just use calculator, man. 16 point? This also repeatedly asking MCQ. Next, when it comes to the problem number 3. The standard deviation of the return on the market index estimated 25%. If the covariance of company A returns with the return on the market index is 0.05, what is the beta of a company? How to calculate beta, ma? Covariance divided by variance. Covariance they given 0.05. It is not a percentage, it is a rate. That's why in a denominator also you need to consider rate, not percentage. Sir, clear, sir? Don't take 25%, consider 0.25. 0.25 or 0.25 square? Why 0.25 square? What they given, Nana? Standard deviation. What required? 0.25 square. 0.05 divided by, what about the 0.25 square, Nana? Karthik, son side rava. Innara sir class? Last one. Interested na? Sure. ఏ టాపిక్స్ కవర్ చేసాం ఇప్పుడు వరకు వచ్చి? ఏం లేదు నువ్వు క్లాస్, నీకు తెలుసా విషయం? నన్ను మోసం చేసే ప్రాబ్లమే లేదు, నిన్ను చేసుకోవద్దు ప్లీజ్. సో ఓకే దెన్ ఫైన్. వాట్ అబౌట్ ది 0.25 స్క్వేర్, నాన్న? 0.0625. Now 0.05 divided by 0.0625. 0.8. More risk or less risk, Nana? More sensitive or less sensitive? Less sensitive. Less than 1. Clear, na? So if there is a less sensitive means your expectation also will be reduced. Why? Because you are multiplying with RM minus RF, na? ఇప్పుడు తక్కువ నెంబర్తో మల్టిప్లై చేసి నీకు ఎక్కువ పర్సంటేజ్ వస్తుందా, తక్కువ పర్సంటేజ్ వస్తుందా? తక్కువ పర్సంటేజే కదా. అదే ఇక్కడ 1.2 ఉంటే 6% రిస్క్ ప్రీమియం అనుకుందాం. 6 into 1.2 మోర్ దెన్ 6ఏగా. లాజిక్ అర్థమైంది ఇక్కడ? ఓకే దెన్ ఫైన్. కమ్ టు ద ఇలిస్ట్రేషన్ నెంబర్ 4, నాన్న. Illustration number 4. Suppose Alpha Limited has a capital structure composed of the following: debt 30 million, equity 45 million. If the before tax cost debt is 11%. Generally, just I roughed here there is a name called pre-tax. There is a name called pre-tax. ఒకవేళ ఆ పదం ఇవ్వకపోతే ఏంటి అని చెప్పడానికి దాన్ని రౌండ్ ఆఫ్ చేశాను అంతే. సార్ క్లియరా సార్? So if they not give pre-tax in box, we know that. What is that? First we have to check tax rate is there or not. If there is a tax rate, what are the percentage of debenture they given? That is a what, Nana? Pre-tax. We need to convert them as a post-tax. The required rate of return on the equity 16.5%. KE they already given directly. The marginal tax rate is 30%. What is the Alpha Limited weighted average cost of capital? only two capitals is there. KO equals to KE into weight of equity plus KD into weight of debt. Where is the weights, Nana? Weight of equity equals to 45 million divided by 30 plus 45. Weight of debt equals to 30 million divided by 30 plus 45. Now 30 plus 45 is known as capital employed. 0.6 equity weight. 0.4. Now what is the meaning for 0.6 and 0.1 means? If I procure 1 rupee, out of 1 rupee, 0.6 paisa is equity capital, 0.4 paisa is a debt capital. Okay. Next, K is already given directly 16.5 na. So I am using rate 0.165 into 0.6 plus 11% they given, it is a pre-tax. 0.11 into 0.7 na. 0.11 into 0.7, why 0.7? 1 minus tax. 1 minus 0.3, 0.7 only na. 0.11 into 1 minus 0.3 into 0.4. Okay, then fine. What about this 0.165 into 0.6 Nana? Here. 0.09, 0.099 plus what about this 0.11 into 1 minus 0.3? 0.7077 into 0.4. If you calculate this, add this one, you will get KO. What's the KO, Nana? KO 0.1298 ORR 12.98%. Sir, clear? Come to illustration number 5. Put a 5. Oh, sorry. After getting your books, you need to put 5-star for this. This is a new question added in workbook about expanded CAPM and build up CAPM. Now read the points, Nana. Here, theory also they given in the question itself. Theory also they given question itself. See, an analyst is examining a private firm under consideration as an acquisition and determine the following. The current capital structure is a non-optimal because the owner avoids the use of debt. So I will give clarity at the time of capital structure explanation, meaning of the optimal. Optimal represent, if you want something, at that point of view, optimal represent maximum. If you don't want, at that time, if you use a word called optimal means minimum. Do you want more KO or less KO? Do you want, as a company, do you want more KO or less KO? Less KO. So which capital structure gives a less KO, that is called optimum capital structure. Do you want maximum MPS or minimum MPS? As your company, do you want highest market price or lowest market price? At that time, optimal represent where I got a highest market price. Nana, clear, Nana? That is the point. The current capital structure is a non-optimal because the owner avoids what, Nana? Debt. Point 2 says that a small stock premium and company specific risk premium are determined because the private firm is much smaller and much lesser diversified than the public firms that beta is estimated from. Next, the industry risk premium reflects the additional risk in the industry compared to the broad market. They just saying about definitions of the risk. Are you guys clear now? Company specific premium means what? Small size premium means what? Industry premium means what? That are the things they said. That's it. Now, when it comes to the relevant figures are listed below. RF. Next, what is the meaning of risk equity risk premium? RM minus RF. So this is a beta. By using these three elements, can I figure out what, Nana? Now see the first question. Calculate the required return on equity using CAPM, the expanded CAPM and build up. So this is the question also, Nana. CAPM means basic CAPM. After that, expanded. After that, build up. Now please tell me the basic CAPM. Values is there. Please calculate. What Nana? 11 point? Okay, then fine. I can easily say expanded CAPM is more than that. Yes or no? No? Yes or no? Now for that, how much Nana? 11 point? 11.4. What are the things you have to add? Company specific, size, liquidity, country. That 4 elements is there or not? Check na. Company specific is there, and the small stock is there. That the 2 things only we have. Liquidity is not there, country is not there. Nana clear Nana? If not there means 0. Now what is the answer? 11.4 plus 3 plus 2. 15 point? 16 point? That only I said. Nana clear Nana? What about the build-up model Nana? For that 16 point we are not adding anything. RF, we are not using beta here. Point to be understand, we are not using beta. RF plus RM minus RF plus small stock plus company plus industry. What Nana? 15 point. 11.4%, 16.4%, 15 point. Any complications? Nana clear Nana? But when come to the exam, you have to write clearly each and everything. Okay? Wait a minute. So this is the class notes, Nana. So this is a concept of CAPM. Everything is covered here. This is a solution. Okay. Next, we completed just case 1. There is a case B. Read the case B. Before reading the case B, we not completed total discussion of the relevant information. We stopped up to industry risk premium. Now when it come to here, they said pre-tax cost of debt 9%. What you want? Post-tax debt or pre-tax debt? If you want KO calculation, you need to convert that 9% into post-tax. Okay. Debt and total capital for a public firms in the industry. Here is not a discussion about public companies. It is a discussion about what Nana? Private company. In top of the question also they said. But they provided for the purpose of industry. Okay, then fine. Optimal debt to total capital, another point they said. Current debt to total capital, another point they said. These are the points for debt equity mix percent, Nana. Weights purpose. Now see, when it comes to the optimal debt to total capital, 12% means what, Nana? Anyone? Optimal debt divided by total capital equals to 12%. What is the meaning for that? If company taking 100% capital, on that 100% capital, 12% is what, Nana? Debt. What about the pending, Nana, out of 100%? What about the value? 80? 88 is equal to equity weights. Nana clear? Now it means when it comes to the first point, same logic only na industry also. So 30% means what, Nana? So weight of debt equals to 0.3, weight of equity is pending 0.7. Now when it comes to optimal debt to total capital, another point they said. Here also we are finding weights na. Weight of debt equals to 0.12, weight of equity equals to 0.88. If you convert into rate, Nana, if it is a percentage, 12%, 88%. If it is a rate, 0.12 and 0.88. Now when it comes to third point, current debt to total capital. Weight of debt equals to 0.03. Weight of equity equals to 0.97. Are you okay? Now read question number 2. Calculate the weighted average cost of capital using the current capital structure and optimal capital structure. It means out of these 3 points, you have to consider point 2 and point 3. They mentioned clearly. Sir, clear, sir? Sir, if there is no clarity about that, which capital structure I need to figure out KO, what's your call? All 3. That's it. Nana, clear, Nana? Next one. Optimal capital structure, assuming cost of equity of 16 KE, they provided 16%. You need to consider specification only. Generally, you have a multiple KEs in above. Basic CAPM, expanded CAPM and build up CAPM. But don't use all 3. Just use a specification. How much they given, Anna? 16%. KE means you need to consider 16 only because specification given in the question paper. Now by using the information, please tell me the KO, anyone? 2 KOs. Write down, if you want, write down in the roughly and then calculate. హ్యూమన్ క్యాలిక్యులేటర్ లాగా ఉన్నావు కదా రా సంబంధం నువ్వు అట్లా లెక్కేస్తుండ్రు. ఫ్రాడ్ నాయాల ఛీ. Hey, please solve it, man. What is the 15.7? If you what follows? Which capital structure you follows? Optimal. If you follows current structure, it's simple, man. Previously they followed 97 is to 3%. And if they want 1 rupee of capital, they are procuring 0.97 paise with help of selling of equity shares, 0.03 paise as a debt. But for their company point of view, the best mix is 88 is to 22, 88 is to 12. Optimal means best for the organization. Nana, clear, Nana? Okay. Wait a minute, you will get a clarity about the optimal. See here. So the word you need to use optimal means you need to satisfy any of this one condition. Not all. Other things remains constant. Ownership not dilute, risk must be low, KO minimum, MPS, EPS maximum. And C, as per plan A, equity 100%. As per second structure, equity 50%, debt 50%. As per plan C, equity 90%, debt 10%. That mix is known as capital structure. But we can't say which option is the best one. If you say it is the best one, that is called optimal capital structure. Nana, clear, Nana? Out of these 3, can anyone tell me which one is the best option? Without calculation, we can't express the decision. Nana, clear, Nana? I will calculate KO for all 3 plans. Here KO equals to 10%, 12%, 9%. What you want KO? Least where? That's why if you use the 90% is to 10%, that is called optimal capital structure as based on KO. Sir, clear, sir? For example, I calculated EPS. 6 rupees, 5 rupees, 4 rupees. Here I am not checking KO. I am focusing only on EPS. Now where is the highest EPS? That is the best capital structure. That is nothing but optimal. Do you understand the difference of current capital structure and optimal? Yes or no? No? Okay. That's it, Nana. See this calculation. This only you did, Sir, we have a multiple Ks. Now, why you are considered 0.16? I mean 0.16 specification. So 9% is a KD, but why you are multiplying with 0.7? 9% is a pre-tax, sir. We want post-tax. If you consider or calculate, you will get 15.7%. Next, when come to if you follow optimal capital structure, weights are changed. What are the weights? Weight of debt 12%, weight of equity 88%. Now, if you calculate, you will get 14.83%. Nana, clear, Nana? Now, they are asked a comment, Nana. They are asked a comment. Which is the best for the company? Which is the best for the company? Highest KO or lowest KO? Lowest KO. Where you get a lowest KO, Nana? What, Nana? Clear? Sure? So this is exam standard problem. Illustration number 6. This question they are in your cmainter also. These are questions not taken from the cmainter. These are the questions I taken from your board book only. Final board book questions. Don't expect this kind of questions in exam. Okay. Clear? If you are lucky, they will give one in December attempt only. They will give inter question 1, either common size statement or comparative statement, ratio analysis. They will give information. In down, they will ask 4 or 5 ratios. At that time, you are so lucky. Why? Because that question number 4A, 4B both are problems. Clear? Instead of that, there is a chance either you will get these KO calculation questions. Okay, as well that capital structure, market value of firm questions also there. Approach with tax, without tax. I think cainter people knows about the arbitrage process. Arbitrage process. I think in cmainter there is no concept of arbitrage process. Two problems they inserted in our material. Only issue why I am not discussing about in detail means we have only 1 or 2 problems for each and every concept. We have a multiple concept. That's why at that time I need to tell each and everything crystal clearly. But only few problems only, not few, 1 or 2. For 1 or 2, that entire discussion is a waste of matter. Nana, clear? Now, illustration number 6, check karo. Mahavir Limited has the following capital structure based on market values. They clearly said what are the values they given. What values, ma? Market values. Are you okay now? Then fine. Equity capital 80,000 shares, 100 face value. How much is the value, Nana? 100 lakhs, 100 lakhs, 80,000 into 10 face value, you will get a book value, 8 lakhs. But they already clearly mentioned market value. 100 lakh is a what, Nana? Market value. Next, 15% preference share capital, 6,000 shares. In books, they are recorded at 100 rupees. 6,000 into 100, how much, Ra? 6 lakhs? 6 lakhs. But how much they recorded, Ra? 6 lakh is the book value, 6,21,000 is the market value. Okay, then fine. 14% debenture, face value 1,000. Face value 1,000. But they are not mentioned number of debentures. You need to take a call. Assumption. Nana, clear, Nana? But what are the value they given? 9,70,000 is there, na? That is what value? Why? Because they mentioned clearly in top. Now please take a call, take an assumption. How many debentures? 100. You can take one debenture also, not a problem. Nana, clear, Nana? You can take one debenture also, not a problem. But that assumption need to be relevant. That assumption need to be relevant for understanding purpose. 1,000 is a relevant, Nana. If you multiply with 1,000 and 1,000, you will get a near value for 9,70,000. 10 lakhs. 10 lakh is a book value, but market value is 9,70,000. They issued at a discount. Yes or no, na? Yes or no, ma? How that 9,70,000 is possible? Book value is 10 lakhs, but issued at what value? Discount value. At that time, automatically, book value is more, market value, issue value is less. Clear? Why we are taking assumption means we want that price value. Why? Because if you want KD calculation, how we calculate KD? Divided with market price only, na? Net proceeds are market price. Net proceeds is not there. I want market price. How I calculate market price? Market value divided by number of debentures. Where is the debentures? Where is the debentures? Assumption. Hope you guys clear? Then fine. 16% term loan. 8 lakh. Here I don't want any market price. That's why I am not dividing anything. Why? Because here security is not there. It is a mortgage document, na? Sir, clear, sir? Next, additional information is very, very important. The dividend per share expected for next year is rupees 3.5. Can I name it is called D1 or a D0? Very, very important considering of D0 and D1. Why? Because in calculation we are using D1 only. Next, expected growth at the rate of growth. So G. Okay. Up to only the information relating to KE. Nana clear, Nana? Okay, then fine. I am find out in specific cost of capital KE ma. I understand it is a dividend with growth model. Why? Because growth rate also is there. D1 divided by P0 plus growth. Are you clear? Now D1 I already have 3.5. P0 growth also there 0.12. What about the P0? They are not given directly, but we have a clue. Market value is there, shares is there. So MPS equals to market value of equity divided by number of shares. Now what is the market value of equity? 100 lakhs divided by number of shares 0.8 lakhs. 80,000 is nothing but conversion of lakhs, Nana. 0.8 lakhs. Answer ma? 125. Now what about the KE ma? What? 14.8%. KE completed. What about next? Preference shares are redeemable after. Can I name it is called N? Can I name it is called redeemable preference shares? Okay. Premium of. What is this premium? Issue premium or repayment premium? Repayment premium. And debentures. That means this is the information only for preference shares. Now KP equals to preference dividend plus repayment value minus market price, na? Or net proceeds. Market price. Market value is there. Number of shares is there. We can easily figure out market price. Divided by N. Whole divided by average. Now, how I find out the preference dividend? 15% on face value. What about the face value? 15, huh? They said repayment at 5% premium. How much they repaid? 105. What about the market price? You have to do working note. 6,12,000 divided by 6,000. 103.5. 103.5 divided by N 5 years. Whole divided by 105 plus 103.5 divided by 2. Answer, Nana? .67%. 68, round off. Okay. Next one. Debentures are redeemable after 10 years at. What about this face value? Issue time face value or repayment time face value? Issue. Hey, not issue, man. Debentures are redeemable after 10 years at face value. Repayment time face value. They are repaying at face value. That is the meaning. Nana, clear, Nana? Now issued at para? No, market. Market values is there, na? Nana, clear, Nana? ఎందుకు number of debentures assumption తీసుకునేది మనం? మార్కెట్ ప్రైస్ ఫైండ్ అవుట్ చేయడానికే కదా. ఇఫ్ దెర్ ఇస్ ఎ నెట్ ప్రొసీడ్స్ ఇన్ఫర్మేషన్ వీ విల్ యూజ్ నెట్ ప్రొసీడ్స్, బట్ దెర్ ఇస్ ఎ నో నెట్ ప్రొసీడ్స్ ఇన్ఫర్మేషన్. వాట్ వీఆర్ taking? Market price. It means we are selling debentures at what price, Nana? Market price only. Clear? Okay, then fine. Yes, I understand it is a irredeemable debenture. Redeemable debenture. Interest 1 minus tax plus repayment value minus market price divided by n. Now how to calculate interest, Nana? 14% on face value. What is the face value? 1000. I am calculating per share, per debenture point of view. How much more? 140. Tax rate is given 40%. Repayment at face value na 100. What about the market price? 9,70,000 divided by assumption. What is assumption? Company issued 1000 debenture for relevant purpose. 970. How many years, Nana? I hope you understand why I consider a relevant assumption 1000. Nana, clear, Nana? Sir, can I take one debenture as an assumption? Yes, not a problem. Answer will not change at that time also. Sir, clear, sir? How much now? 8.18. 8.83. 8.83. Clear? All completed other than term loan. Bacha thing hai na, term loan. 16 into 40, 60%. How much ma? 14.8. 14.6. 8.8. 8.8 only na? 83, yeah, you said 8.83. So I consider just two numbers. Next, KT 9.6%. KT. Okay, then fine. Please calculate weights, ma. Please calculate weights. How to calculate weights, Nana? Please total the capitals. 100 plus 6.21 plus 9.7 plus 8. 123.91. తీసుకొని చెయ్యి నువ్వే. అందుకే కదా రిలవెంట్ అసంప్షన్ అని చెప్పింది. అందుకే కదా రిలవెంట్. ఇప్పుడు 100 దగ్గర నెగిటివ్ వచ్చింది, నెగిటివ్ తీసుకుంటావా? అప్పుడు ఏం చేయాలి? ఇంకొక అసంప్షన్ తీసుకోవాలి. క్లియరా? సార్ అర్థమైంది అబ్బాయి చెప్పిన పాయింట్. ఇఫ్ దే టేక్ irrelevant assumption, you will not get answer properly. That's why I said relevant. I used name na relevant assumption. Okay, then fine. Where we are? Yeah, please tell me the weights na. 100 divided by 123.91, 6.21 divided by 123.91, 9.7 divided by 123.91, 8 divided by 123.91. 0.807, 0.050, 0.078, 0.064. If you multiply with specific cost of capitals, you will get what, Nana? KO na? Now KO. KO please. KO please. నోట్స్ ఇవ్వకుండానే ఇలా ఉంది. నోట్స్ ఇస్తే ఇంకా మామూలుగా ఉండదేమో. ఇంక డైరెక్ట్గా ఆన్సర్ చెప్పేసి అయిపోద్దాం క్లాసు. కొంచెం ఒళ్ళు దగ్గర పెట్టి చేయండి సార్. When it comes to the exam, the issue creating things are basic things only, sir. Why? Because we are spending time for difficult things. We are not spending time for basic things. So if you write in a tabular format, it will take time. That's why you can use the directly shortcut. No problem. Okay. So okay guys, calm down. .14. Any issue? In the textbook also 14.0 something, no? They're taken approximately 14%. Here also you can take approximately 14. Okay. అరే చూడాల్సింది కాన్సెప్ట్, సొల్యూషనే కాదు. ఇంకా పర్ఫెక్ట్గా బుక్లో ఉన్నదే దిగాలంటే కుదరదు ఎవడికి. నువ్వు రాస్తావు బుక్లో ఉన్నదే, బుక్లో ఉన్నదే నువ్వు రాస్తావు, వస్తుందా? ఎక్కడ ఎక్కడ ఫైండ్ అవుట్ చేయాలి అక్కడ ఫైండ్ అవుట్ చేయకుండా ఏందిరా. ఓకే. సో ఓకే ఫైన్. వెన్ ఇట్ కమ్ టు ద నెక్స్ట్ కాన్సెప్ట్ నాన్న, capital structure. So in this capital structure also we are calculated valuation. So what are the things we figure out in a capital structure? All are valuation only, market value of the firm. Here firm represent company. Ana clear nana? In above cost of capital also we did a valuation. That valuation is called valuation of share. Shuffling of the KE formula, we will get a P0 or V0, na? That is called valuation of share. In this chapter we did a valuation of company, but we are not using a name called company, we are using a name called valuation of firm. Okay. So first I said already, there is a 3 plans: plan A, plan B, plan C. As per plan A, company following 100% equity. As per plan B, company following 50% equity and 50% debt. Company followed here equity 90%, debt 10%. Out of these 3 mixes, which is the best mix is known as capital structure. Nana clear nana? If you want money, we can't procure what you want. You need to procure money with proper structure. Sir, clear sir? ఇప్పుడు మనం ఒక ఎగ్జాంపుల్ మాట్లాడుకున్నాం. కాస్ట్ ఆఫ్ క్యాపిటల్కి 100 కోట్లు కావాలంటే అందరి దగ్గర 20 తీసుకొచ్చాం. ఇంకొకరిని అడిగాను అనుకో, నేను మొత్తం ఈక్విటీకి తెస్తాను అంటాడు. ఇంకొకరిని అడిగాను అనుకో, ఆడు 50 ఈక్విటీ తెస్తాను 50 డెట్ తెస్తాను అంటాడు. అంటే ఎవరికి నచ్చినట్టు వాడు తీసుకొని వస్తే అది క్యాపిటల్ స్ట్రక్చర్ అయిపోదు. నాన్న క్లియరా నాన్న? దట్ స్ట్రక్చర్ మస్ట్ బి ఆప్టిమల్. దట్ స్ట్రక్చర్ మస్ట్ బి వాట్ నాన్న? ఆప్టిమల్. ఆప్టిమల్ మీన్స్ బెస్ట్ నాన్న. Sir, clear sir? How we decide best means, when you are procuring a money with help of different mixes, theoretically you have to check 2 points. Ownership. Where we are losing ownership? Option A. Nana clear nana? If you are procuring only with help of equity means what you are losing? Ownership. Ownership need not to dilute. Are you okay? That's why A is not a best option. When it comes to C, yeah, comparing to B, C also we are losing ownership, na? That's why C also not a optimal. What is optimal? B. Sir, clear, sir? Okay, then fine. Next point, you have to check risk, Nana. Debt is a risk. Are you agree? For whom? Owner. Company is nothing but owners only, na? Owners. Okay, then fine. Point A, no risk. Yes or no, sir? Why? Because no debt, no risk. Company B, risk is there. Risk is there. If you compare with the C, high risk. Nana, clear, Nana? Risk is there in B mixture, C mixture. Where is the highest risk? B. What you want? Highest risk or lowest risk? So B is cancelled, C also cancelled. Which is the best one? A. Risk must be what, Nana? Low. Are you guys clear? At that time only we are using a optimal capital structure. Next, Nana, these are the theory. When it comes to the practical calculation, we are calculating KO for these three options. Are you clear? Where I got a highest KO or lowest KO? Lowest KO, that is best optimal capital structure. Are you guys clear? So KO low. Next, another practical EPS calculation. I will calculate EPS for option plan A, plan B, plan C. Where I got highest or maximum EPS, that is my optimal capital structure. Clear? Next, another point is there, Nana, MPS. What do you want? Highest or lowest? Same. I need to calculate MPS for option A, option B, option C. Where I got highest, that is my optimal capital structure. Next, Nana, market value of the firm. I am figuring market value of the firm for plan A, plan B, plan C. Where I got highest market value for my company, that is the best optimal capital structure. Do you understand now? Optimal capital structure means? Sir, clear, sir? For proving that optimal capital structure, we have approaches and analysis. Approaches and analysis. Analysis related problems is not there in Spm&Bv. Approaches related problems is there. But just I will give what is the analysis. EBIT to EPS analysis. EBIT to MPS analysis. Indifference analysis. Indifference point analysis. Financial break-even point. These are the points covered under what, Nana? Analysis. What is the purpose of analysis? To prove what are the structure you followed is a what structure? Optimal capital structure. This EPS calculation is there, na? That is nothing but EBIT to EPS. This MPS is there, na? That is nothing but EBIT to MPS calculation. KO you already know how to calculate KO. Sir, clear, sir? Now indifference point analysis, financial break-even point is not required. But just I will give, just listen and leave it about that. Indifference point means at particular level of EBIT, both plans EPSs are same. Nana, clear, Nana? If I earn some X amount of EBIT, for that EBIT, plan A EPS is same, plan B EPS is same. That is a concept set by indifference point. Financial break-even point means at a particular level of EBIT, EPS equals to 0. At a particular level of EBIT, EPS equals to 0. What that says means, if we earn X amount of EBIT, that is sufficient for interest payment, first interest, tax, preference dividend. If there is a preference dividend, there is nothing for EISH. If there is a no EISH means no earnings for owners. In simple concept, no earnings for owners. Nana, clear, Nana? Okay. These are the topic called analysis. So I hope you know the income statement. Income statement. As per financial decision, one income statement is there. As per capital investment decision, another income statement is there. Two different income statements we have. As per financing decision, సేల్స్ మైనస్ వేరియబుల్ కాస్ట్, కాంట్రిబ్యూషన్ మైనస్ ఆపరేటింగ్ ఫిక్స్డ్ కాస్ట్ మా. ఆపరేటింగ్ ఫిక్స్డ్ కాస్ట్ ఇంక్లూడ్ ఇంట్రెస్ట్ ఆర్ ఎక్స్క్లూడ్ ఇంట్రెస్ట్? Exclude interest. That's why I used a name called operating fixed cost. Interest is a finance fixed cost. If you remove this, you will get EBAT, nana. On that EBAT, first you have to remove what? Interest. That is the point we learned. Interest 1 minus tax. Tax advantage. If you not remove interest, you need to pay tax on EBAT. At that time, you are paying more tax or less tax? More tax. If you remove interest after you paid a tax, you are paying a less tax. That is called tax advantage. Nana, okay na? Now EBT. On that EBT, you need to pay tax. If you pay tax, you will get EAT, earning after tax. On that earning after tax, if a company have a preference share capital, you need to remove preference dividend. That is the point I said at the time of writing the document. If a company got a profits, I will not share to owner first, I will share to you. If any pending is there after payment of you, I will share to my owners. That is a preference. Importance I am given to that document or a holder. After payment of preference dividend, you will get EA, ESH. This is called owner's profit. Nana, clear nana? If there is a one owner, I will share entire EA, ESH to that guy. If there is a 5 owners, divided by 5. If there is a 2, divided by 2. If there is a 1 lakh, divided by 1 lakh. Nana, clear nana? Now, divided by number of shares, you will get what ma? EPS. Are you okay? Now, MPS we can calculate in multiple ways. We learned few things already. Another thing is called multiply with PE ratio. This concept is there, I will explain. If you multiply with PE ratio, you will get what ma? MPS. This is called EBAD to EPS, EBAD to MPS. You need to start from here to here. That's it. Are you okay now? Okay, then fine. So analysis is completed. The next discussion, approaches. Here 2 types of approaches is there, Nana. Irrelevant approaches, relevant approaches. Can anyone? Irrelevant approaches, relevant approaches. Okay. If capital structure changes, market value of firm also changes. As per option 1, what is the structure you followed, Nana? 100% equity. If you choose option B, your capital structure changes or not? What you choose? 50% equity to 50% debt. This is called change in capital structure. Okay? If your capital structure changes, based on that change, your company value also changes. Market value of firm also changes. That is called irrelevant approaches. Nana, clear Nana? Now, for proving this sentence, we have a 2 concepts. Net income approach, traditional approach. Net income approach, traditional approach. Now, relevant approach represent capital structure changes, market value of firm remains constant. Market value of firm remains constant. If you are shifting from plan A to plan B, capital structure change or not, Nana? But market value will not affect. That is called relevant. Now, when it come to here, for proving this sentence, we have 2 concepts. Net operating income approach, MM approach. Net operating income approach and MM approach. I think these are the 4 concepts we learned in cmainter. Nana, clear Nana? Okay, then fine. The first one, net income approach. Nana, listen each and everything. What I said, highlight that, keep that as a practice. That's it. As well, basically, ఎలా ఉందంటే నేను చెప్పినవి జరగలేదు కాబట్టి నేను చెప్పలేకపోతున్నా. క్లియరా? నేను వచ్చినది చెప్పుంటా బుక్ గురించి. నేను ఆల్రెడీ చేసిన ప్రామిస్ ఫిల్ చేసుకోలేకపోయాను, దానికే కామ్ అయిపోయాను. సో బట్ యాజ్ వెల్ యాజ్ పాసిబుల్ వచ్చేస్తాయి. నాకు చెప్పింది అయితే ఈరోజు ఆఫ్టర్నూన్ కానీ ఈవినింగ్ కానీ. SPM&Bv SCM కలర్ ప్రింట్కి వెళ్ళింది, మనం స్టాండర్డ్ కాస్టింగ్ ఫినిష్ చేసుకునే లోపల వచ్చేస్తుంది. ఇదైతే నార్మల్ ప్రింటే ఇచ్చామని చెప్పా. ఓకేనా? కలర్ కావాలా? కలర్ కావాలంటే టైం ఇది కలరే. కాన్సెప్ట్ బుక్ కలర్ వస్తుంది. హ్యాండ్ రైటింగ్ కలర్ రాదు నాన్న, వదల కనుక్కుంటా. హ్యాండ్ రైటింగ్ కూడా ప్రింట్కి వెళ్ళిపోయింది. ఐ డోంట్ నో రా, అదంతా నా చేతిలో లేదు. ఓకే దెన్ ఫైన్, కమ్ టు దిస్ కాన్సెప్ట్ రా. సి నెట్ ఇన్కమ్ అప్రోచ్. This net income approach concept created by one guy. That guy name is called David Durand. David. Sir, clear sir? So what he says means, here we need to follow some assumptions. Without assumptions, these theories will not work. Guys, clear? Without assumptions, these theories will not work. The assumptions are, first assumption, there is a guaranteed EBIT. There is a guaranteed EBIT. What's the mean for guaranteed EBIT? If company do business, EBIT must. Is it true? Profits are fluctuate, na? Yes or no, sir? But assumption, we can't do anything. Yes, there is a EBIT for every firm. Okay. Next, second assumption, in market only two sources of funds. In a market, only two sources of funds: equity, debt. Sir, in cost of capital you said 5 sources, na? The cost of capital chapter. Sir, clear sir? As per David, assumption is what? Only two sources in the market. One is equity, another one is debt. The third assumption, debt is cheaper than equity. Debt is cheaper than equity. They said reasons also. Even though it is an assumption, there is a reasons. Why? Because KD have a tax advantage, KE don't have. Yes or no, sir? As well, in our example also we discussed, irrespective of profits we are paying interest. That's why they will not expect more. Why? Because they are not a risk takers. Nana, clear nana? So that's why in market, debt is a cheaper fund, equity is a costlier. So KE is greater than KD. Sir, clear sir? Now another assumption, KE remains constant. KE remains constant. Why they taken this assumption means, if debt come into the company as a owner, are you agree that risk? Debt come into the company, you are the existing owner. Are you accept that risk? No. When you accept, if they give extra KE, yes or no, na? Your expectation will be increased because of risk, na? పాయింట్ అర్థమైందా? కంపెనీకి డెట్ వస్తుందంటే రిస్క్ వస్తున్నట్టే కదా. యాజ్ ఎ ఓనర్ రిస్క్ బేర్ చేయడానికి రెడీగా ఉన్నామా ఫ్రీగా? వాట్ యూ వాంట్? మోర్ ఎక్స్పెక్టేషన్. దట్ ఈస్ నథింగ్ బట్ యు ఆర్ ఎక్స్పెక్టింగ్ మోర్ కేఈ. సార్ క్లియరా సార్? బట్ హీ సెడ్ ఓనర్ ఆర్ డమ్, దే ఆర్ నాట్ ఎక్స్పెక్టింగ్ ఎనీథింగ్, దే విల్ పే రిస్క్. దట్ ఈస్ అసంప్షన్. కేఈ రిమైన్స్ కాన్స్టెంట్. He understand, he created another theory, net operating income approach. One again he only, by considering that point, no one will take risk with free of cost. That is a net operating income approach. As of now, are you understand? Owner will take risk. That's why KE remains a constant. These are the assumptions they followed, Nana. Okay. This theory is practically implemented by a lot of people. Vijay Mallya, Adani, Cave Coffee Day owner. Why? Because if they want capital, they are not procuring with the help of equity share capital. They are procuring only with the help of debt. Nana, clear, Nana? So due to debt, David says that there is an advantage. What is advantage means? What you said, KE is greater than KD or KD is greater than KE? KE is greater than KD. It means KD cheap only, na? If you raise cheap fund, KD less, due to less KD, KO what happen? Decreases. If KO decreases, company market value of firm increases. That is a theory propounded by David Durand. Nana, clear, Nana? Now see, so market value of firm equals to EBIT divided by KO, Nana. This is called capitalization concept. This is called capitalization. I will give clarity why I consider EBIT. Why? Because we have a multiple profits now. Contribution is a profit, EBIT is a profit, EBT also profit, EAT is also profit, EI, ESH also be profit. Why I consider EBIT, I will give later. I will give clarity later. Just value of firm calculation equal to EBIT divided by KO. Okay, then fine. Company require additional 50 crore rupees. They have two options. Option 1 equity, option 2 debt. What David says? KD is lesser than KE na? KD is less than KE na? For example, if you choose equity funds, you have to pay 12%. Nana clear? If you choose option 2, are you pay more than 12% or less than 12%? Less than 10 or less than 12, that is nothing but 10%. Na? Company already existing, they are paying KE equals to 12%, existing 100% equity. Existing 100% equity. Now if they choose option 1, how much they need to pay, Nana? Existing 12%, new 12%. The total KO, how much they need to pay? If they choose option 1, they need to pay 24%. If they choose option 2, for existing shareholders 12%, for new debenture holders, how much? Total, how much they need to pay? KO equals to 20? Nana, clear, Nana? If you choose debt, your KO, what happened, Nana? Decreases, na? Clear, sir? Now, for example, EBIT equals to 2 lakhs. Now, please calculate market value of the firm as per option 1. 2 lakh divided by 0.24. As per option 2, 2 lakh divided by 0.22. What, Nana? Option 1, 8 lakh, 33,000. Okay. What about option 2, Nana? 9 lakh, 0909, 90909. Nana, clear, Nana? Which market value is highest? Option 1 market value or option 2 market value? Why this market value is highest? Because of why KO low? Why KO low? Because of debt. Nana, clear, Nana? These figures I taken for understanding of the concept. This much of cost will not there in the reality. 22%, 24%, that much of cost is not there. Just understanding purpose I taken that figures. Are you okay? Akka logic setgaddu. Are you clear, sir? What is the thing you need to learn? Debt is a cheaper fund. If you rises, your KO decreases. If your KO decreases, market value of firm. Clear na? What that concept says? If capital structure changes, market value of firm also changes. Previously, what the structure they followed? 100% equity. Now, if they choose option 2, what happened? Capital structure change na? Now, what is the now capital structure? Equity plus debt. Previously only equity, now equity plus debt. If capital structure changes, market value of firm also changes. Proved. Nana, clear, Nana? This is a theory, that's it. But here, for exam point of view, you need to learn calculation. Market value of firm equals to EBIT divided by KO is a one option. Market value of firm equals to market value of equity plus market value of a debt, second option. Now when it comes to market value of equity, how I calculate market value of equity means, before that understand this concept. Now every profit has a alternative names, Nana. Every profit has a alternative names. Contribution is also be known as variable profit. Contribution is also be known as variable profit. EBIT is also be known as operating profit or business profit. Operating profit or business profit. EBT is also be known as taxable profit. EBT is known as what, Nana? Taxable profit. EAT is known as net profit. EAT is known as net profit. That is very, very important. EAT is net profit here. Okay. EAESH is known as equity profits or equity shareholders profits. Nana, clear, Nana? Now what I am figuring out in here? Equity value or company value? EBAT divided by KO. Company value. That's why what profit I need to capitalize means company profit. What is a company profit? EBAT only, no? Yes or no, sir? Okay, then fine. Why you consider KO instead of KE and KD? Profit talks about overall. Cost also need to talk about overall. Nana, clear, Nana? That is the logic behind the EBAT divided by KO. That is called capitalization model. I said one example. Ramesh, I taken a X rupees of amount. At the end of the month, I said I send 10,000. I said 10% rate of interest. How much is the capital? 1 lakh, na? 10,000 divided by 10%. Sir, that is a concept name called capitalization. Sir, clear, sir? Okay, then fine. The next one, market value of equity. It talks about overall organization or part of the organization. Equity portion. That's why here you have to consider EAESH divided by K. EAESH divided by K. Market value of debt also overall or part of the organization. Interest divided by KD. Nana, clear, Nana? Are you okay? Now, how to calculate EAESH you already know. I said income statement. See, this is the calculation part. Okay, and this is the theory explanation. I written assumptions also. David Duran. And the assumptions these are. One assumption I missed here. KE remains. Why KE remains constant, Nana? Why KE remains constant? What are the owners there in the company? They are not expecting anything if risk came into the company. Just an assumption, we can't do anything. But reality, no one will accept. Yes or no, no? So in reality, what happened? In reality, what happened? Reality, what happened means, if risk is came, if I need to continue with free of cost of about that risk, I will not continue. I will leave the company. If they want you, they will give an offer. I will pay extra money, extra KE. Now what happened means, what are the benefit they received because of KD, they need to compensate to. They need to compensate to whom? Owners. Why? Risk bearing. That is a practicality, na? Oh, 5% తగ్గిందన్న డెట్ వల్ల ఇవ డెట్ వల్ల 5% తగ్గిందని హ్యాపీగా ఎంజాయ్ చేస్తున్నా. ఓనర్స్ వచ్చారు దగ్గరికి, రిస్క్ వచ్చింది మేము ఉండవు అనేసి. వాళ్ళని వదిలేసామంటే క్యాపిటల్ పోతుందిగా, వాళ్ళు కంటిన్యూ చేయించుకోవాలిగా. ఏం చెప్పాలి వాళ్ళకి ఇప్పుడు? నేను ఎక్స్ట్రా ఇస్తారా? ఎంత అయితే రిస్క్ వచ్చిందో అంత నేను ఇస్తాను రా నేను చెప్తా. ఎంత బెనిఫిట్ ఎంత అయితే వచ్చిందో అది మొత్తం మళ్ళీ తీసుకెళ్ళి ఎవరికి ఇవ్వాలి? ఓనర్స్కి ఇచ్చేయాలి. 4% decreases, 4% compensated. Any impact on KO? 4% decreases. KO also decreases. Now again you compensating means KE increases, na? If KE increases, automatically set of that KO remains constant. Now tell me, if KO decreases, market value what happen? Increases. If KO, vice versa, opposite. If KO increases, market value what happen? If KO constant, market value also constant. Nana, clear, Nana? Why KO constant? What are the benefit I received due to debt? I am compensating to equity shareholder. Because of that set of 4%, my KO remains constant. If KO constant, market value of firm also. That is a net operating income approach. Again said by David. He did a mistake in net income approach. He rectified that in net operating income approach. That is a theory. There is a no calculation part. Hope you guys clear. I will explain again also, not a problem. So first, do you understand this net income approach? Calculation part, okay? Clear? Now, there is a concept name called traditional approach. Traditional approach. This traditional approach also says that what, Nana? If capital structure changes, market value of firm changes. Now this traditional approach says that up to limit everything is good. Up to limit everything is good. If limit crosses, what are the benefits you enjoyed previously that reconvert as what, Nana? Disadvantages or negatives. This is applicable for our human life also. Everything is fine up to point. If point crosses, we can't do anything. Now the intention of this traditional approach is what David said, debt is a cheaper fund. If you rises, KO decreases, market value of firm increases. Na? Every time if you rise the debt, KD what happened? Ra? Every time you are rising the debt, what he says, debt is a beneficial. Because of beneficial, if I rise again and again, KD accumulates. Na? KD accumulates. If KD accumulates means at one point of time KD starts to increase. If KD increases, KO. Overall KO increases only, na? If KO increases, market value of firm, what happen? See the chart here. So before limit advantages, after limit disadvantages. Before limit what happened? Debt is a cheaper fund. Due to that KO decreases. Because of KO decreases, market value of firm increases. After limit crosses, summation of KD I used, accumulated KD. Due to accumulated KD, what happened? Increase the KO. If KO increases, market value of firm decreases. That is a concept set by traditional approach. These all are just for MCQ purpose, not for the calculation purpose. So the calculation purpose, I said these two logics. Nana, clear, Nana? Apart from this, there is a concept name called Modigliani-Miller approach. And that Modigliani-Miller approach also, problems is there. Two problems they provided. In that Modigliani-Miller concept only, there is a subclassification concept, arbitrage process. Anyone know the arbitrage process? Arbitrage. That is a concept of SFM only. I think in portfolio only that came arbitrage process. Nothing, the people are doing trading in share market, they knows that. So if they will purchase two company shares, and the two company shares, if any company share is falling, okay, what they will do means, they will sell high price share. With the help of that high price value, they will purchase more number of shares in low price. Logic athamautunda? Short selling. And the process of short selling, they can get a profit, basic profit. That basic profit is nothing but arbitrage gain. Sir, clear, sir? Practically is different, sir. In our book is different. In book, they are followed some assumptions. Based on that assumption, they calculated. Clear? Don't compare with the practically. Okay, then fine. We will continue tomorrow.